Hi everyone, my name is Jonathane Ricci and you can call me JR. I'm a licensed lawyer in the states of New York, Michigan, United States with a combined 25 plus years experience. I have been making videos on expanding your business globally, making money in more than one jurisdiction, tax optimization, asset protection, structuring yourself properly, and of course the big bad tax man in different jurisdictions who wants to tax you more. It's more than their fair share. The main umbrella of these videos is something that I call Unjust Matters, uncovering injustice worldwide. Today, we're going to be talking about something that a lot of people making money in crypto don't want to hear, but absolutely need to understand. Governments are coming for crypto taxes, and they're getting very, very good at it. If you are making money in crypto and you are not reporting it properly, this is not a maybe problem. This is an inevitable problem. Let's break this down in a way that's simple, clear, and practical. What's happening globally? Let's talk about that first. Over the last few years, countries all over the world have started tightening the rules on crypto taxation. We're talking about places like Canada, the United States, many European countries, Australia. These countries are tightening their crypto rules. These countries used to treat crypto as something new, something unclear, but not anymore. Now, these countries are saying this: if you made money, we want our share. And they're building systems to track crypto. A big part of this is something called the Organization for Economic Cooperation and Development Crypto Asset Reporting Framework, also known as something called CRAF. Think of it like this. Banks already report your accounts to the government. Don't know if you knew that or not. Now, crypto platforms are being pushed to do the same thing. So the idea that crypto is somehow invisible is disappearing fast. Now let's talk about how crypto is taxed. Let's keep this real simple. In most countries, crypto is taxed in one of two ways. The first way is through something called a capital gains tax. This applies when you buy crypto low and sell crypto higher. It's that simple. The profit, according to these countries, is taxable. For example, let's just take a really simple example. You buy Bitcoin at $10,000. You sell it at $30,000. You made $20,000 profit. Governments want their tax on that $20,000 profit. In countries like Canada, about 50% of the gain is taxable, then it's taxed at your personal rate. In countries like the United States, this tax could range from 0 to 20% federally, plus whatever the state charges or the state taxes are. The second way crypto is taxed is something called an income tax. This is not new. We all know income tax. And this applies when you trade frequently. Maybe you stake crypto. Maybe you mine crypto. Maybe you get paid for your services in crypto. Now the government says, this is This is not just investing in crypto. It's income. And income tax rates can be much higher than the rates I just talked about. In some countries, some income tax rates can go as high as 40 to even 55% total tax rate. So let's talk about the reporting requirements. And here's where people get into trouble. It's not just about paying tax. It's about reporting everything properly. Reporting everything properly. For example, in the United States, there's a question right on your tax return. The question is simple. Did you deal with crypto this year? Now, if you don't answer that correctly or ignore it, it's a serious issue. Another example. In Canada, we have something called the Canada Revenue Agency. The Canada Revenue Agency expects full reporting of gains, trades, or even barter transactions using crypto. Globally, reporting is expanding through, for example, the common standard, the common reporting standard, and now crypto-specific frameworks like the CRAF I just talked about. What does this mean? What does this mean for us? This means that exchanges are starting to have pressure to report your activity. Countries will share that data with each other. Now, here's something that's important to understand. What are the penalties for non-compliance? Let's discuss the consequences. If you don't report properly, here's what can happen. There could be financial penalties, fines, interest on unpaid taxes, large reassessments going back years. There could be audits. Tax authorities can go back years, 3 years, 6 years, depending on the jurisdiction. Sometimes even more years if they suspect fraud. 3, there could be criminal exposure. Yes, I said that right. There could be criminal exposure. In serious cases, you can face tax evasion charges. That means, and I'm not trying to scare anybody, but that means heavy fines, possible jail time. This, my friends, is not theoretical. Governments are actively pursuing crypto cases as I'm recording this podcast. The big shift that you need to know about, something called forensic crypto tracking. Now, here's the part most people underestimate. Governments are hiring forensic blockchain experts. Companies like Chain Analysis and companies like Elliptic, these companies can trace crypto transactions. These companies can follow wallets. These companies can link activity back to real people. I want that to sink in for a second. Even if you think I moved my crypto to another wallet, no one can see it. That's often incorrect. Something about blockchain. Blockchain is permanent. It's like a public record. And once they connect your identity to a wallet, they can follow everything. In closing, what is the warning I am referring to? What am I really trying to convey to you? And let me be very clear on this. This is important. If you are making money in crypto, wherever you are making money in crypto, whatever wallets you're using, if you're making money in crypto and you are not reporting it properly, not paying tax, not structuring your activities, we're going to talk about that in a second, not keeping records, you are building a problem that will eventually surface. Not today, maybe not even tomorrow, but eventually, yes, it will surface. The smart approach is simple, and we're going to get into what that is. We're going to get into what proper tax reporting, proper legal structuring, proper documentation. This is how you stay ahead of everything I'm talking about. Now, before we wrap up, I want to leave you with something very, very important. Not all of this is bad news. It may sound like bad news, but not all of this is bad news, because there is a right way to do this. If you structure your crypto activities properly, you can reduce your tax exposure. You can stay compliant. You can protect the value you've built. Let me explain this very simply. Right now, most people in crypto are doing everything in one place. Same person, same wallet, same control, same tax exposure. And that's where the problem starts. What sophisticated investors do, and what I advise clients globally, is this. They separate things properly. 1, ownership versus control. Just because you benefit from crypto doesn't mean you personally should own it directly. There are legal structures, companies, trusts, foundations, where one party owns the asset, another party controls decisions. That separation matters. Because tax authorities look at who owns it, who controls it, where that control is happening. 2, let's talk about wallet management. Wallet management. Most people have one wallet, maybe 2, and everything flows through it. That's a mistake. I want you to consider this. A better approach is different wallets for different purposes. Clear documentation of what each wallet is for. Controlled access, not just one person doing everything. What does that do? That creates clarity, audit defensibility, reduced risk. Number 3, and I always harp on this, number three, proper documentation. This is where almost everyone fails. If you cannot explain why a wallet exists, who controls it, what its purpose is, how decisions are made, then from a tax authority's perspective, they will assume the worst. They will come up with their own story and assess you on it. I've seen that happen many times. Good structuring means written agreements, clear authority, defined roles. And finally, 4, jurisdiction. Jurisdiction matters. Where things are controlled from matters. Where entities are formed matters. Where decisions are made matters. This is exactly what I've been talking about in my previous podcast videos discussing proper international structuring. Done properly, this can optimize taxation legally, reduce exposure, create long-term protection. Done incorrectly, it creates even bigger problems. What's my final message to you? Here's the real takeaway. Crypto itself is not the problem. Gains in crypto you're making, money you're making is not the problem. Poor structuring is the problem. No planning is the problem. No documentation is the problem. If you treat crypto like a serious asset class and you structure it like serious money, you can stay compliant. You can optimize taxes. You can protect what you've built. And that's the difference, my friends, between reacting later under pressure and planning properly from the start. This is how you stay ahead of what's coming. Once again, I am JR. This is a video in the Unjust Matters Uncovering Injustice Worldwide series of my podcast. If you found this video helpful, share it with someone who needs to hear it. Because a lot of people in crypto and making money in crypto are about to learn all of this the hard way. My preference? I'd rather they learn it the right way. Thank you very much for your time.
This is a presentation by Jonathane Ricci, JR, and JR Wealth Management. The content provided herein is for educational, informational, and commentary purposes only, and does not constitute investment, legal, tax, and/or other professional advice, nor does it establish any professional and/or client relationship. And further, nothing contained herein is meant or should be construed as defamatory or as intending to harm the reputation of any individual, business, or entity referenced. JR and JR Wealth Management provide management advisory and consulting services, and, where appropriate, use qualified licensed attorneys and/or other qualified, registered, and/or licensed professionals.